The first time. Your laptop, I think the fridge can translate to show up. Well, let's just do the next section, but let's see if it can show up the first one. I think we'll show it in this. All right, so 1 o'clock. Let's go and get started. All right, good afternoon, everyone. How's everyone doing today? Good, good. Day after the midterm. I'll say right, I haven't looked at the midterms yet. I'm probably going to start grading them tomorrow, either tomorrow or Monday, but I'll have them back to you by Tuesday. So my plan is to finish grading, so you'll get them back a week after we took them. So look forward to that. Okay. All right. So the plan for today is we're going to continue on with our lecture notes on depreciation and taxes. And so we started this last Thursday. So today's going to be mostly filled with just examples of different tax calculations, how to do different depreciation schedules, and all that good stuff. Okay. So the next homework 4 is going to be posted. I'm going to try to do it right after the class today, so you'll have that ready for you. I'll see how far we get today, and then I'll determine when the due date for that is going to be. But look forward to homework 4 being posted later today. Okay. All right. I think that's all my announcements. Are there any questions I can answer before we get started for today? Okay. All right. So let's go and get started. And so what we were doing last week was depreciation and taxes. So last Thursday, we introduced the concept of incorporating taxes into our calculations, right? Because everything that we've been doing up to this point, everything we did with midterm 1, we've basically just ignored the fact that taxes exist, right? But taxes play a very important role in all kinds of economic calculations, and so we need to kind of know how to do that, right? And so just to kind of refresh your memory, right? The main taxes that we'll be talking about are primarily income taxes, right? So there's all different kinds of tax in the world. There's sales tax, property tax, all those good things. But we're specifically focusing on just income tax, right? So income taxes is money that's paid to the government. Right? The government uses that money to pay for, public services like police, fire department, road construction, all that good stuff. And the way it's computed is that it's computed based on a percentage of the money that is earned by a company. So that's the key component there, right? And so we went over this formula last time. The taxes that you pay is equal to the product of the income or the revenue that you make multiplied by the tax rate, right? Very simple. Okay. Right. Of course, there are ways to reduce this, right? So there are ways to reduce your tax burden. And the primary way that businesses do this is by reducing this number right here that I'm pointing to. Okay? Right. So what we were talking about last time is that, what businesses and even individuals nowadays too, I think we're seeing a big rise of people who are self-employed or self-contracting out, right? Usually what people do is that they try to reduce their taxable income as much as possible by deducting away their business expenses. Okay. And by business expenses, that means money that you pay out to run your business, right? So any business requires money to be paid out, whether you're paying for labor, you're paying your employees, you're paying for materials to produce your product or whatever. It even goes down to electricity costs, internet costs, software costs, things like that. Okay. And so these business expenses are split into two main categories. And so on the one hand, we have a category called ordinary and necessary expenditures, which I'll just shorten to necessary expenditures. Right. So ordinary necessary expenditures, these are expenses that you put out that are for materials or for labor that generally lasts less than 1 year, right? So these are either raw materials that are going to get used up and you're going to sell, or this is money that you pay to your employees. And so this is money that's kind of used up, I guess you can say, within a year. Okay. The other category of business expenses, which we're going to spend the majority of our time focusing on, is depreciation. Right. Because one thing, especially as this is especially true for engineering companies, right? To run any kind of engineering firm or to have any kind of engineering department in your company usually requires the purchase of some large equipment or some very expensive equipment, right? Even companies that do primarily computational work, right? So you're going to work on a computer, you work on SolidWorks, you work on ANSYS, right? You still need to buy the computers that you're going to use to run your business, right? So the thing about these large capital expenses is that they're not used up within a year, right? You can see these types of things as an investment themselves. Right? That's what we talked about last time, was that for these capital expenditures or capital purchases, their value will slowly decrease over time. Right. And so if you're going to use this piece of equipment, for 2, 3, 4 years, right? If you sell this piece of equipment somewhere halfway through, you're going to recoup some of that value because that large capital purchase retains a lot of value, year to year. Okay. And so what we said for tax purposes that if you're buying this large piece of capital equipment, then and you're doing your taxes, right? The amount of deductions that you can take should equal the amount of value that purchase lost per year. Okay. Okay. And that's kind of the central kind of theme or the central idea behind all the calculations that we're doing, right? You buy a capital purchase, right? You pay a very large amount of money up front, right? And then over time, a percentage of that value is lost per year, and so you're going to deduct that loss from your taxable income. Okay. All right. So that was just kind of a recap from last time. Are there any questions on any of this? Okay. All right. So let's jump into the calculation, right? So what we talked about last time as well is that to compute depreciation, there are multiple different ways to do it. In fact, there are 4 different ways that we're gonna go over in this class. So the first type of depreciation that we're going to go over is something called straight line depreciation. Okay. And in this in this form or this depreciation scheme, your asset or your capital purchase will lose a fixed amount of value each year. Okay. So really, it's the easiest depreciation scheme to kind of go over just because that amount is the same. So it's kind of our launching point to some of the more complex ones, right? Okay. And so the formula that we had for this is that we have depreciation. So this is the amount that you could deduct from your taxes per year. This is equal to B minus S divided by N. Right? Where B here, this is the initial cost or initial value of your purchase. S here is the salvage value. And N here is the number of time periods. All right. Well, that's really all there is to it, to straight line depreciation. And so how this actually factors into our cash flow calculations we'll do in the next example. Okay. So this next example that I'm going to do, get used to it because we're going to be doing the exact same example 4 times, each one with a different depreciation scheme. Okay. All right, so let's jump into it. All right, so for this example, let's say that our company purchased a new truck. And let's say that this truck costs $50,000. Okay. All right, so this truck is expected to last 5 years. Okay. And then based on the capacity of the truck, based on what the company's planning on using it for, it's going to produce roughly $20,000 of revenue per year. That's your income, right? So before we go any further, right? Since we are getting into the taxes realm here, right? This $20,000 here per year, you can expect to be taxed on this. Let's say will be taxed. Okay. All right. So even if we assume just federal taxes, right, that means 21% of that $21,000 per year is going to be paid out in taxes. So that's $4,200 per year. Okay. Of course, we're not going to pay all of that because we're going to reduce our taxable income, but just to kind of give you an idea. All right, so at the end of the 5 years, the truck will still be functional at that point. But it's estimated that the truck will be valued at about $10,000. Okay. All right, so let's compute. Let's compute 2 things. So first, let's compute, let's do this problem as if it were kind of our traditional present worth calculation. So let's compute the present worth of this investment. But we're going to do it, we're going to ignore taxes like we usually do. We're going to buy our truck, we're going to write it, and we're going to run away from the IRS. That's part one of this problem. All right, part two, we are going to compute taxes. So we're going to compute. And the way we call it the after-tax present worth. Okay. All right, so that's our situation. Pretty simple. So it's a pretty much just very straightforward investment type of cash flow here. So we have a capital purchase with an initial cost. We have the yearly revenue, and we have the salvage value. So we can work this. Any questions on just the setup for the problem? Oh, sorry. We need two things. We need the tax rate and we need the interest rate. Right. So we're going to assume the interest rate here is 10%. And the tax rate, we are just going to assume federal taxes. So we're going to assume 21%. Excuse me. Thank you. Oh, that sneeze has been on my nose this entire lecture. Okay. Let's do part one. So part one, we know how to do. So this is just our very standard cash flow conversion type of problem. We know all the cash flows here. We know the interest rate. And so all we have to do is just convert everything to a present worth. Okay. So present worth is equal to, we have our initial cost. So our initial cost is 50,000. Right. So that's a cost. So we're going to add a negative there. We have our revenue. So revenue is $20,000 per year. And so this is a uniform series. And so to convert it to a present sum, we need to do P over A, 10%. And the time period for this is 5 years. And then finally, the last thing that we have here is the salvage value. And so the salvage value is 10,000. That's happening at the end of the 5 years. So this is a future sum. This is P over F, 10%, and 5. Okay. All right, so pretty straightforward cash flow conversion here. Everything is in standard form, so we don't need to do any non-standard conversions. And so we can look up these conversion factors in the compound interest table, or you can do this with formulas. That's perfectly fine too. Okay. And so we punch in all the numbers, we get 32,029. Oops. $32,029. All right. So I wanted to do that just to kind of give you a sense of how much impact your taxes are going to be. Okay. Because you think, I think the thing that people would think is that, our tax rate here is 21%, right? And so would that mean that our after-tax present worth would just be 21% less of this? We'll see. So we'll see what that looks like. Okay. So part two, we want to compute the after-tax present worth. Before we jump into that, though, we need to compute the depreciation, right? Because that truck that we purchased, it's going to depreciate in value each year. All right, so the depreciation, we're gonna use straight line. That's the only one we know so far, okay? And so our formula for straight line depreciation is B minus S divided by N, okay? So B here is our initial cost. Our initial cost is $50,000. Our salvage value here is $10,000. And N here is 5, okay? So I have 50,000 minus 10,000 divided by 5. And so that, if we put this through, we get a depreciation amount of $8,000, right? So under a straight line depreciation scheme, our truck is going to lose $8,000 of value per year. Right. So each year that we use the truck, that's $8,000 that we're never going to get back, right? So even if we sell the truck after 2 years, right, we're gonna lose out on 8,000 times $2, right? Because that's the amount that is lost. And so since this is money that we are spending, essentially losing to run our business, we can deduct this from our taxes. Okay. Okay, so let's see what that looks like. So I think right before we ended up last time, we talked about doing this in table format. Right, so typically with tax calculations, you want to do everything in a table. All right, so the first column of the table is going to be the year. Okay, second column is going to be the before tax cash flow. Okay, next column is going to be depreciation. So that's how much we're going to subtract away from our before tax cash flow. Next column is going to be taxable income. So that's the amount of income that we're going to be taxed on. Okay. Once we compute the taxable income, we can then multiply it by the tax rate in order to get our taxes for that year. And then after we subtract out our taxes, we can then obtain our after-tax cash flow. Okay. All right, so what we're going to do here is we're going to fill in all of the entries in this table until we have it for all five years. Okay, so we're going to make this table for 5 years. Don't forget year 0. Okay. So let's start filling this in. So first we have year 0. So year 0, the only thing we did in that year is we just purchased the truck. Right? So our before tax cash flow in that case is a minus $50,000. Nothing else has happened at that point, and so all we did was purchase the truck, so we haven't lost any value yet. There's no taxes. We already, assumingly we already paid the tax that's on the $50,000 price tag. Okay. But from here on out, we're going to have taxes for each year. Okay. All right, year 1. So this is the end of year 1. So we've been using the truck for 1 year, right? All right, we know that in this first year, we've made $20,000 of income, right? So the before tax cash flow is $20,000. In that 1 year, our truck has lost $8,000 of value. So the depreciation at the end of year 1 is going to be $8,000. Okay. All right, next column that we have here is taxable income. So that's how much income that we're being taxed on. And so in order to compute the taxable income, we're going to take our before tax cash flow. And then we're going to subtract our deductions. Okay. So the deductions can include ordinary and necessary expenditures and depreciation. Okay. So in this problem, I didn't give you any ordinary or necessary expenditures, but they can exist, right? So the only deduction that we're considering in this problem is just the depreciation. And so if we do $20,000 minus the $8,000 of depreciation, our taxable income in this case is $12,000. Okay. Our taxes in this case we're going to take our taxable income and multiply it by our tax rate. And so if our tax rate is 21%, we take 21% of 12,000, we get. Okay, 2,520. Okay. And then once we compute our taxes, we can then compute our after-tax cash flow. So our after-tax cash flow is we're going to take our before-tax cash flow, which is our income, right? So we earn $20,000 of income. We're going to pay $2,520 in taxes, right? So do $20,000 minus 2,520, and so after that we're left with 17,480. So for this last column here, this last column is before tax cash flow minus taxes. Okay. So after paying taxes, that's what we're left over with in the last column. Okay. All right. Any questions on how we got all the numbers on that row there? Okay. All right, so let's go ahead and repeat this. So because this is a fairly simple case, our income is the same every year, our depreciation is the same every year. Rows 2, 3, and 4 are all going to be identical. So let me just go ahead and write that in really quickly. Year 5 is going to be a little bit different because we have the salvage value there as well. So we're basically making the assumption we're going to sell the truck after 5 years. But before we get there, let's fill in the rows for 2, 3, and 4. So years 1, 2, 3, 4 are all identical because we're making the same money, to the $20,000 of revenue. Our depreciation is the same. Each year we're losing $8,000 of value. And so the amount of taxes we pay are the same, and the after-tax cash flow is the same as well. Okay. All right, year 5. Year 5, we're gonna have an additional $10,000 of revenue because we're gonna use the truck for the whole year, and then at the end of the year we're gonna sell the truck for $10,000. So in this last entry right here, this is revenue plus salvage value. Okay. You want to be cognizant of that. And so if you're doing a problem, a tax problem, which does have a salvage value, and usually the assumption is that you're going to sell it at the time that you're going to salvage, right? And so you need to make sure you incorporate that into your before tax cash flow. All right, so during that year, the truck lost $8,000 of value, just like all the other years. And so our taxable income in that case is $20,000. And that means the amount of taxes we pay that last year is going to increase as well. And so the amount of taxes we're going to pay is $4,620. All right. So the after-tax cash flow in that year then is going to be 30,000 minus 4,620. Okay. And that gives us 25,380. All right. So now that we've computed all of our after-tax cash flows, we can now compute our after-tax present worth, right? Because what we have here is we have our initial cost, we have our after-tax cash flows here, okay? So let's convert all of these to a present sum. Tax. Okay. So we have present worth is equal to, okay? We still have our initial cost, and so our initial cost is still a minus 50,000. Okay. So we need to incorporate that because that's going to be important for our calculations. Okay. Next, we have the after-tax revenue, right? So the after-tax revenue is 17,480. So it's going to be multiplied by P over A. Our interest rate is still 10%. Okay. All right. So we have that income of 17,480 for 4 years, right? So years 1, 2, 3, and 4. Year 5 here is different, and so I'm gonna treat that a little bit differently. And so for this P over A, I'm only going to do it for 4 years. Okay. Okay, and the last thing I'm gonna do here is have a 25,380 P over F, 10%, right? This is a one-time future sum, so it's a P over F, 10%, and it is occurring at year 5. Okay. All right, so once again, we can plug in all of the conversion factors here from the table, and what we get is an after-tax present worth of 21,171.7. Okay. So if you compare that to our before tax calculation, so compare that to part 1 of this problem, right? If we ignore taxes completely, we would have a present sum of 32,029. Okay. After taxes, it's a lot less, and so it's actually about 1/3 less, and so we end up with an after-tax present worth of $21,171.79. So this is much less, or taxes played a big impact. So taxes is not something that you can ignore. It is annoying, right? And so you'll see in a bit, once we get into the other depreciation schemes, taxes can be very annoying to deal with, but they're important. If you don't incorporate taxes, then your calculation is going to be very wrong. Okay. All right. Any questions on how we got to that answer there? Okay. All right. So that's the first the first depreciation method, and also that's the first example where we kind of broke apart a cash flow by table. Okay. And so you'll be doing these kinds of tables for all the problems in this unit. Okay. So before I introduce the next depreciation method, let's kind of take a step back and talk about a few things. Okay. So first, let's kind of ask the question of what kind of asset can be depreciated. So we just did an example of a truck. So vehicles are kind of a very easy depreciation case because it's for almost all vehicles, as long as you're using it right, it's going to go down in value, and they're very expensive. All right, but what can be depreciated? Okay, so the first criteria for depreciation is that the asset must be used for business purposes to produce income. Okay? The key word there is for business purposes, right? So that means, any asset, you buy a lot of personal assets yourself, right? So you buy your own car to use, you rent an apartment, you buy a house, right? These are very large purchases, but for the most part, most people don't use these for business, right? So you use your personal car just to drive around. It's not something that you use for business, right? Even if you have to commute to work, right? Technically, you're using your car to go to your place of business. That does not count as actually a business purpose type of car. That's just transporting you to your job. Okay. So people have tried, and I say because people have tried to kind of use their own or take their own personal purchases and deduct that from their taxes. And so if you have any good tax accountant, they'll probably tell you no. Okay. Of course, nowadays the lines for that are being blurred just because more and more people are kind of working from home. They're, running their own businesses and using their own personal cars and things like that. So, it's definitely gotten complicated, but, you have to use the asset or use the purchase for your own business. Okay. Okay. Number two, the second criteria is that the asset must have a useful life that can be determined, and it must be greater than one. There's ideally there should be some data in terms of how long an asset like this is typically going to last, right? Trucks last for 5, 6, 7, 8 years. A computer will last for 5, 6 years, right? So there's data on these things. Okay. And the idea is that it's not something that's going to be used up in a year, so it's something that's going to decrease in value over many years. Okay. So criteria number three is that the asset must decrease in value over time. And so the longer you keep the asset, generally it's expected the asset will lose value. Okay. And so that's either through use, getting worn up, decaying, becoming obsolete, just any way that the asset can lose value. Okay. All right. And so judging by these three criteria, I'm going to give you a little thought experiment here, a little thought question, right? You don't have to answer now. In fact, it's going to be one of the questions on the homework. Okay, but it's definitely useful to think about now. So one thing that's used a lot in businesses, is land, right? So let's say that you're building your Amazon, right? You're buying land for a new warehouse or a new factory, or you're a small business. You're buying land to make a storefront to your brick and mortar. Okay. And so the question I want you to think about is, does land count as a depreciable asset? Think about the three criteria that we just talked about now, and think about if land counts as that. Okay. All right. All right. So let's get to the next depreciation method. So the next depreciation method is called declining balance depreciation. All right, so the idea with declining balance depreciation is that instead of declining by a fixed amount each year, the rate at which an asset loses value each year stays constant. Okay. And so what I mean by that is that, compared to the previous year, the in declining balance depreciation, the asset will lose a fixed amount of whatever its current value is. All right. So the formula for this, so I'll call it D underscore T. So that's the declining balance depreciation amount. Okay. This is just one example here. There's different percentages that you can use, but this is kind of um, the standard, or kind of the default. So you're going to take 2 divided by n multiplied by the previous book value. So the amount of value that the asset had in the previous time step. All right, so this one's a little bit more complicated than our straight line depreciation, because we're not decreasing by a fixed amount. And so with this method right here, we need to keep track of what the current book value is, right? Remember, we defined book value last time. Book value is just whatever value that the asset has on paper. Okay. Okay. Any questions on declining balance or anything we talked about so far before we do another example? Okay. All right, so let's do another example. Well, it's the same example that we're going to be doing with declining balance. Okay. Okay. So in this example, let's say that we're purchasing a truck. We're doing it again, right? We're going to purchase our truck for $50,000. We have a before tax revenue of $20,000 per year. So our income is $20,000 per year. Okay. So we're gonna ignore the we have the salvage value, so we're gonna salvage it. So we're gonna salvage it for $10,000 at year 5, just keep everything consistent with the previous example. Okay. And so if we assume an interest rate of 10% and a tax rate of 21%. Okay. So exact same numbers from the previous example. Let's compute the after-tax cash flow, but we're going to use declining balance depreciation. Okay. All right. So let's make our table again. Okay. I'm gonna add a column to the table. So at the end of the column, I'm gonna have a column for book value. Okay. All right, so we have year. We have before tax cash flow. We have a column for depreciation. Our next column is going to be one for taxable income. I had another line there just because it's a little bit close to my other writing. Okay. We have another column for taxes. Right. We have our after-tax cash flow. And then a new column that we're adding is book value. Okay. Technically, we could have added this book value column to our previous example, but with straight line depreciation, we didn't really need to keep track. Okay. Okay. So let's go ahead and write our rows in. So we have 0, 1, 2, 3, 4, and 5. Okay, so let's go ahead and fill this table. All right, so first year or year 0, I should say, nothing changes. So we're gonna have a minus 50,000. Okay, that's our initial cost. At time period 0, we have not depreciated anything, or we haven't paid any taxes, so all the other columns are blank. Okay. All right, let's do the second row. Okay, so the second row here. Second row, we're going to start out. We're having a before tax cash flow of 20,000. Okay. Okay. Next, we have a depreciation. So with declining balance depreciation, the way that we compute this. Oops. Okay, the way that we're computing this is we're going to take 2 divided by the number of time periods. So our number of time periods here is 5. Okay. So we're going to do 2 divided by 5 multiplied by the previous book value. Okay. Maybe I should have done this. And so let's go back to year 0 here. Okay. And the book value at the end of year 0 is 50,000. Right? So the book value is nothing more than just the current value of the asset. Okay. All right. And so if we're going to compute the depreciation, we're going to do 2/5 multiplied by the previous book value. Okay. If the previous book value in this for this row here is going to be 50,000, we're going to take 2/5 of 50,000, and so our depreciation is 20,000. Okay. Actually, let me write in the expression here. This is going to be 2/5 1,000 is equal to 20,000. Okay. All right. And so if our income is 20,000 and our depreciation is 20,000 as well, we subtract the two. That means in that first year, we have zero taxable income. Okay. And if we have zero taxable income, that means we pay zero taxes. So our after-tax cash flow in the first year is going to be 20,000. Okay. Same as our before-tax cash flow because we didn't pay any taxes on that. Okay. And then after that, the book value. Okay. So to compute the book value, okay, let me do this in blue actually. Okay. The book value, the way that we're going to compute this is the previous book value. Okay, so previous BV minus the depreciation for that year. Okay. Because remember, the depreciation is how much value our asset is losing. Okay. And so in that first year, if our depreciation is 20,000, that means our book value is going to be 50,000 minus 20,000, which is 30,000. Okay. All right. So under this different depreciation scheme, our truck has lost $20,000 of value. Okay. All right. Any questions on how we got all the numbers in that row there? Okay. All right. So let's go ahead and continue it for the next row. So for the next row, our before tax cash flow is the same as before, so it's going to be 20,000. Okay. Our depreciation is going to change though, because our book value has changed. And so just like we did before, we're going to take 2/5. We're going to multiply it by the previous book value, but now the previous book value is 30,000. Okay. So we're going to do 2/5 of 30,000, which is 12,000. Okay. So in that second year, our truck is going to lose $12,000 of value. Okay. And so if we subtract these, we take 20,000 minus 12,000, we get $8,000. Okay. The amount of taxes that we're going to pay on that is 21% of 8,000, which is 1,680. And if we're paying 1,680 in taxes, that means our after-tax cash flows will be 18,320. Okay. All right. So finally, what we'll do at the end of year 2, we're going to update our book value. And so before year 2, we started with a book value of 30,000. We've depreciated 12,000 of that, and so our remaining book value is 18,000. Okay. All right, let's do the next row now. So year 3. Year 3, our income in year 3 is going to be 20,000 as well. Okay. Let's compute our depreciation. So you're going to see our depreciation is going to get less and less and less each year. Okay. So we're going to take 2/5 multiplied by the previous book value, which is 18,000. Okay. So 2/5 of 18,000 is 7,200. Okay. All right, we subtract that from our before tax cash flow, and we have a taxable income of 12,800. The amount of taxes we're going to pay that year is 2,688. Okay. And then the after-tax cash flow is 17 312. Okay. All right, so once again, we're going to compute our new book value. So our new book value is 18,000 minus 7,200, which is 10,800. All right. So next two rows, I'm just going to go fairly quickly. You know, it's just kind of a repeat of the same. Okay. One thing that you should notice is that, you know, because our depreciation is getting less and less over time, the amount of taxes that we're gonna be paying is increasing per year as well. Okay. All right. So in the last row here, don't forget the salvage value. So the salvage value is going to add $10,000 of income. Okay. And then our final book value here is 3,888. Okay. All right. So of course, you know, the book value there, first of all, you should notice the book value doesn't go down to zero. That's okay. Okay. And another thing you may notice is that the book value doesn't necessarily correlate to the salvage value in this case. And we'll talk about that in a second. Okay. All right, but now that we have this, we are now ready to compute the after-tax cash flow. Okay. This one's going to be a lot more annoying because each year is something different, but we're going to do the same as before. We're going to take our initial cost, 50,000, and all of our after-tax cash flows here. And so since all of them are different, we can't use any uniform series, and so we have to treat all of them as an individual future sum. Okay. So this expression is going to get a little bit annoying just because we have, you know, 6 different terms to compute here. So our present worth is going to be minus 50,000. That's our initial cost, plus 20,000 B over F, 20%, bless you, and 1. Okay. Year 2, we have 18,320 P over F, 10%, and 2, plus 17,312 P over F, 10%, 3, plus 16,707.2 P over F, 10%, at 4, okay, plus 24,244.32 P over F, 10%, and 5. Okay, so I took each after-tax cash flow in each year and then multiplied by a P over F factor, right? Changing the N value for each one. Okay, All right, so if we plug in all these numbers here, we plug in all 5 of these conversion factors, what we get is an after-tax present worth of 22,792 and 47 cents. All right, any questions on that? Okay. All right. So we're in the last 15 minutes, and so I'm not going to go over the next 2 methods. We'll save that for Tuesday. But I want you to compare this number, this after-tax present worth, with the straight line value. And so I'm going to scroll up a little bit here. And so our straight line value for after-tax present worth, if you look back to our previous example, was 21,171.79. Okay. First of all, what you should notice is that you're getting different answers, right? And that's normal. That's expected. Okay. And so the after-tax present worth, or the cash flows that you compute, depend on the depreciation scheme that you choose. Okay. And that's going to have important consequences in a what that we'll mostly talk about on Tuesday. Okay. But if you compare these two, right, with the declining balance method, we have slightly more present worth. Okay. And that's not by accident. That's expected. Okay. Because if you compare the 2 methods, right? So if you look at the table, right? If you look at the cash flow tables for declining balance versus the straight line, right? One thing that should jump out at you is that with the declining balance method, a lot more of our depreciation is front loaded. Okay. And so if you look, and so what I mean by that is if you look at the depreciation values in years 1 and 2, right? Let me highlight it here, highlight in green. Okay. And so if you look at this value, you look at that value, right? If you compare that to the straight line value, right? In straight line, we were depreciating a flat $8,000 per year. Okay. But with declining balance, we front load this, and so we depreciate more upfront. And generally, that's what you want. So generally, it is more preferable to depreciate more of the value up front. And generally, you're going to see companies kind of, position themselves or kind of do their taxes in a way that does this. Okay. So you might be thinking, like, why is that? Because, even though, we got a lot of tax breaks early on, later on in the cycle here, we were really hit with a bunch of taxes, right? So the taxes later on in the cycle is much higher compared to our straight line. Okay. Right. The reason it's better to depreciate more of your assets value up front kind of goes back to just our general understanding of the time value of money, which is that money is always more valuable, cash is always more valuable earlier on. The sooner that you can get the cash, the sooner that you can kind of do things with it, right? So in this situation where you're having all your tax breaks up front, you can take, that full $20,000 of revenue that you got in year 1, right? And you can invest them, right? Versus in the straight line, you kind of have to wait a long time for your tax breaks to come, right? And that's time that could be valuable that you could use to either grow your business either invest that money more or, do stuff with it. Okay. So generally speaking, companies are going to want to depreciate more of their asset value up front because it leads to more money in the present time. Okay. And so even though you're paying more taxes later, it's better for you up front because by the time you're paying those higher taxes, whatever money that you saved up front, you could have invested that and used that to pay for those higher taxes. Okay. But there is a drawback to this, okay, or I should say a risk. Okay. Because one consequence of this is that if you're depreciating more aggressively, that's kind of the terminology that's used, right? So you kind of aggressively deplete the book value. Right? If you aggressively deplete the book value and you end up selling the asset, right, you may have to pay more taxes depending on the difference. Okay? All right, because if you notice, I've been very careful. I've been very careful about my terminology here, right? And so this value here that we're using in declining balance, I'm calling it the book value, and it's called a book value because that's the value of the asset in the books, in your tax books. Okay. Oftentimes, this is going to be different than what's called the market value, which is the actual amount that you can sell the asset for. Okay. Because the book value is the book value basically tells you how valuable your asset currently is just for tax purposes. The market value is what you're actually going to sell it for. Question, yes.
So I just gonna ask why the book value in the last table it went lower than the salvage value.
Yeah, we're going to get to that. Yeah. So when you have situations like that, like you're going to have a salvage value that's higher than your book value, right? So that salvage value is essentially the market value of your truck at the end of the 5 years, right? And so if that's the case, if there is a difference, right, you will likely have to pay taxes on the difference between whatever you sold it for and the book value. And so if we look back at the last example, so we did neglect this in the last example, right? And so if you look at year 5, right? In year 5, we sold the truck here for $10,000 at the end of year 5. So that had nothing to do with taxes. That's just, we found some guy on Craigslist who wanted to buy the truck for $10,000. Okay. But our book value, so according to our tax books, our truck was only worth $3,888. And wow, that is very bright. Okay. So according to our tax books, our truck was only worth 3,888. Okay. So that means that we earned, according to the IRS, we earned a difference of $10,000 minus 3,888, which is $4,112. Okay. Right. So if we were to do this properly, we would basically get taxed on this extra amount, 4,112. Okay. Right. And so in this situation, which does happen a lot, right? Just because companies generally are going to be pretty aggressive in their depreciation. This is called ordinary gains. And so let me visualize it for you. It's a little bit easier to see. Okay, so if this bar right here represents the market value. Right, so let's say that you sold your asset or you sold your truck for that amount. But this bar right here represents the book value. That's however much your asset is worth according to your tax books, right? And for whatever the difference here is, so this right here is the difference. This right here is called ordinary gains. Okay. Right, so this happens very often because generally speaking, companies will want to kind of keep their assets, but want to kind of increase their tax breaks early on. And so when companies do end up selling their assets or they kind of offloading them, right, they often get taxed on this difference here. Okay. And that can happen a lot if you use a scheme like declining balance. Okay. All right. But if the opposite occurs, so let's say that, let's say that you sold your asset at a value that's lower than the book value. Okay. Then this is called a loss. Okay. And in that case, the difference is not taxed. Okay. So the government kind of catches you a break there. So you made a bad investment, you sold something for a really low price. They're all right, we're not going to double punish you. You already kind of ate the loss already. Okay. Okay. A third kind, which is I think in the news quite a lot, is this idea of capital gains. Okay. So this is very relevant if you're into kind of stock trading or trading, investments and things like that. Okay. And so in capital gains, your asset is sold for more than the book value, but also more than its original cost. Okay. And so in this case, this would be an asset that doesn't depreciate at all. Okay, so this would be something that by this sense, it kind of gained value over time. Okay. All right, and of course, just like ordinary gains, these capital gains are also taxed, but they may be taxed at a different rate. And so it's good to kind of differentiate these. Okay. Any questions on any of that? Okay, all right, so that's all we got time for today. And so when we come back on Tuesday, we'll finish up our taxes and depreciation unit. So I have a couple more examples to do. And then after that, we'll move on to the next topic. All right, so thank you guys for coming today. I hope you guys enjoy your weekend. I'll have your midterms ready to give back on Tuesday. And so if you come to class on Tuesday, I should have them ready to give back to you guys at that point. Okay. All right, thank you guys for coming today. Hope you have a good weekend. Grading, probably most likely. How about you?
I think I might be going from now.
Nice, nice. I went up to the mountains about a year ago, after it rained a lot. We went to Mammoth to just to snowboard. It was actually my buddy's bachelor trip. But it snowed so much we almost got stuck there. And so I almost missed.
Planning on going to Mammoth this week or next week.
Okay. Yeah, just be careful. It's yeah, if it snows a lot, you don't want to get snowed in.
Yeah, we've been up there sometimes. Me and my buddy went up there over winter break.
Yeah.
And we genuinely almost ended up snowed in.
Oh my gosh.
It was like 3 feet.
Jeez,
It
oh
was,
my
it was
gosh.
like, to be fair, we didn't think it would snow.
Yeah.
We didn't bring a shovel or anything. So we're standing there with like, the ice buckets they give you in
Yeah.
Hotel 6?
Yeah. Oh my
Sitting there
gosh.
digging out the car with an ice bucket.
Yeah, when we went up there, it was sick because there was like snow piled up because we're on the second floor. And so there's a big pile of snow on our balcony. So we just take some beers and just toss them in the snow. Wait a couple hours. Oh, that's nice. But yeah, have fun this weekend then.
Thanks, man.
Yep.
You too.